Hello, this is Steve Sanangelo once again from the SRS Rock Report, and today I'm glad you're joining me because this is a very important subject matter. It's going to be what is known as the U.S. Shale Ponzi Scheme explained. And it's very important that my listeners and precious metal investors understand this information because I believe lousy shale energy economics will pull down the entire U.S. economy. And let me get started with this first chart explaining why. Now, this is a series of charts from the EIA, which is the U.S. Energy Information Agency. It does a forecast of new production each month. This is for May. The largest field in the U.S. is the Permian. Now, it says 3 million barrels a day, but about 1 million barrels is conventional and about 2 million barrels a day is unconventional shale horizontal drilling. The second is the Eagle Ford. It hit a high of about 1.7 million barrels in 2015. It fell. It's producing about 1.3 million barrels a day. The Bakken, it's producing 1.2 million barrels a day. It's the third. I don't agree with this number. There's a reason for that. I can't get into that now. I will explain that in the future. And then the fourth is the Niobrara, and it's producing about 600,000 barrels a day. Now, I wanted to show you those fields because of this chart. This is by Bloomberg. It's called Burn, Baby, Burn. Shale business hasn't funded itself, whether at $100 a barrel or 50. We've got the Permian, the Bakken, the Eagle Ford, and the Niobrara. Now, this is what is known as free cash flow. When it's down, it's negative. So there's 33 companies in these figures. As you can see, all of them, Permian is in black, the Bakken's in blue, Eagle Ford's in red, Niobrara's in green. They've all been losing money. And this is, I believe, the third quarter or second quarter of 2017. Now, this is an extended chart. I showed you the Permian, which is the largest shale field. This shows you their estimated increase in production. For May, the EIA believes the Permian will increase production by 274,000 barrels a day. However, the legacy decline is 201,000 barrels. So they get a net increase of 73. Now, their new production decline rate, if we take the 201 divided by the 274, it's 73%. Now, that's the new production. That's not the overall field. I'll show you that in a minute. However, the companies had to produce at least 201,000 barrels just to remain flat, not to lose. Also, in that last chart, it showed that between 2012 and the middle of 2017, the Permian the companies producing the net result was 40 billion more in capital expenditures than they received in operations to produce this oil and gas. So it's not economic, not even in the largest field. Now, I've got a few charts that look like this, and they come from N.O. Peters, who runs the shaleprofile.com website. It's an excellent website. I recommend you go take a look, and you can put in, there's a lot of great information. You can put in individual companies, individual areas, counties. He really breaks it down. Now, what's interesting about this is year of first flow. Each year is a new color. And as you notice, as production builds, what happens? The decline rate becomes from subtle to very steep. And at the beginning of 2016, when the production was about 1 million barrels a day in the Permian, within 2 years, at the beginning of 2018, if no new production was added, no new drilling, it would have fell down below 400,000 barrels. That's a 60% decline. This is the reason why shale is not economic. It's just the decline rates are so severe. Now, N.O. Peters shows also the top producers in the Permian. And we have Pioneer, Concho, EOG, Cimarex, and Devon. Now, what I did is I went back and looked at their average production for the year. This is an end of year. Also, these figures are a little bit different than Eno's because he includes royalty and other things, but it's similar. But again, Pioneer's average production in the Permian last year was 148,000 barrels. Concho was 119, EOG was 91, Cimarex 45, and Devon was 31,000 barrels a day. I want you to focus on the top two, but remember EOG, there's a reason for that. As I mentioned, you could take it in the shaleprofile.com, you can take any individual company and plot their production. So what we see, Pioneer's Resources oil production declined from 150,000 barrels a day at the beginning of 2017 down to less than 70,000 barrels a day in the beginning of 2018. If they added no new drilling in the Permian, it would be a 53% decline in 1 year. Now, this chart shows Pioneer Resources oil production and accumulated capital expenditures between 2007 and 2017. These are its accumulated capital expenditures. This isn't how much they spent in 1 year. This is adding it all up continually. And then the oil production is in the red line. Now, Pioneer Resources spent $24.2 billion to increase oil production from 25,000 barrels a day in 2007 to 159 in 2017. However, according to the Permian, 53% of its oil production would disappear without any new capital expenditures. So if there were no capital expenditures, oil production would fall to 70,000 barrels a day. This is the problem that no one is looking at. So when we understand that free cash flow is the important metric to look at because capital expenditures are shown on the cash flow statement, they're not shown on the net income, it gives a much more realistic view of what's happening to the company. Now here, from 2007 to 2017, 2 years, Pioneer made $169 million together, 2009 and 10. That was the only 2 years they enjoyed positive free cash flow. They made money from operations. All these other years, they've lost money. So if we add them all up together, including these, they lost a combined $7.9 billion, or a negative free cash flow of $7.9 billion. Now, Concho, which is the second largest producer in the Permian, they're looking even worse. They had $4 million in 2007. That was it. That was their positive free cash flow, way 10 years ago. It's been a sea of red. You add them up together, it's a negative 8.7 in free cash flow. Now, how is that possible? How can Concho and Pioneer continue to produce this oil and gas if they're losing money? Well, I'll show you how. And now Pioneer is shown in the green bars and Concho is in the brown bars. Here we have their negative free cash flow. Pioneer was $7.9 billion and Concho was $8.7 billion. Well, what they did is, one of the ways is stock issuance. You issue new stock. You find investors and you promise them better returns or higher stock prices. And so the net issuance for Pioneer between 2007 and 17 was $5.1 billion. I believed overall was $5.6 billion. They did issue 5.6, but they purchased back 500 million. So net was 5.1 billion. Concho was 4.9 billion. But Pioneer, their net debt issuance over that 11-year period was 1.1 billion, and Concho was 2.1 billion. So when you add those up, this is how they're making up for this loss. They're issuing stock and they're issuing debt. Now, I don't have a chart, for example, Continental Resources. They're in the back end. They didn't issue much money in shares, but their debt has ballooned to 6.5 billion. So they issued more debt. Their net debt issuance was very high. Now I want to show you the second largest, which I know Peter's here has an update of the Eagle Ford oil production through January 2018. Now, different than the Permian, the Eagle Ford peaked at the first quarter 2015 and declined, even though it's gone up now. I don't think it's going to surpass this number, and I'll show you why. Now, again, every color is a new year. They add new production. And at the end of 2014, it was about 1.6 million barrels a day of oil production coming out of the Eagle Ford. However, by 3 years, 1, 2, 3, 15, 16, and 17, by the beginning of 2018, it had fallen to less than 400,000 barrels. So if all production ceased in the Eagle Ford, it would decline 76% in just 3 years. So this is why it's a Ponzi scheme, and I'll explain that in a minute. Now, I mentioned EOG was the third largest oil producer in the Permian, which is the largest oil field in shale field in the United States. It's the largest producer in the Eagle Ford. Now, even though its production didn't drop as much compared like the whole field, it fell, but it's increased back again. It too had a 77%. It went from 260,000 barrels a day at the beginning of the end of 2014, beginning 2015, and it fell all the way down to less than 70,000 barrels a day by the beginning of 2018. So if EOG did no new wells, this is how fast their production would fall. Now, what's interesting, we're looking at 2017 here. Production started at about 220, fell, and then now it ended up at about 240. So it increased it. Let's just give it 20,000 barrels. EOG spent $4 billion. Now, this isn't all their fields, but they spent $4 billion in 2017 to increase production marginally. Free cash flow minus dividends was $73 million. Now, let me show you their chart here, or actually their table. This is what I call EOG financial magic. This is what these companies are doing. If we look at EOG Resources consolidated statements of cash flow to 2017, 16, and 15. We go down to their net cash provided by the operating. This is the money they make from operations, 3.5 billion. This is in thousands, so it's 3.5 billion, 2.3 billion, 4.2. Now, underneath is additions to gas, oil, and gas properties. They're not buying properties. This is capital expenditures. This is what the massive amount of money they're spending to produce the oil and gas. It was 4.7 billion. They lost 1.1 billion in 2015. They lost again in 2016. But here we can see it looks like they made a little bit of money. EOG made about 300 million, a little less than 300 million in free cash flow. However, they pay dividends. They pay 386 million in dividends. That has to come from somewhere, from cash from operations. So that's the negative 73 million. They still spent 73 million more paying the dividends. Now, how did they do that? Well, EOG sold 1.5 billion in assets. We go here, proceeds from sales of assets. We look here, they're selling assets. But you can't continue to do that forever, you know. And then long-term debt borrowings. They borrowed nearly $2 billion in 2015 and 16 to fund business and to pay back $1.7 billion in existing debt. Okay, we go to the red. You see they borrowed $900 million in 2015 and $991 million in 2016. And then here they paid back $500 million in 2015, $563 million in 2016, and they paid $600 million in 2017. Now remember that number. I I don't have a free cash flow statement for EOG. They had 3 years of positive free cash flow, but when you net it all together, they still spent $10 billion more than they made for operations. Now, by spending $10 billion more, and the reason why the shale oil industry, it's just not EOG, the reason the shale oil industry is a Ponzi scheme, it's because this is EOG Resources debt repayment. Look what they have due and look at all the years they have this due. There's $6 billion that is due in this period of time. Now, remember I told you the 600 million? Well, they paid that off in 2017. See, this is the interest rate they're paying to investors, 5.87% senior notes due 2017. Well, they paid that off. But in 2018, they have 350 million due. 2019, they got 900 million due. And then 2020, they've got a billion due. In 2021, 750 million. In 2023, they got 1.2 billion. Now, they're not making the positive free cash flow to pay this back. So they're going to have to issue more debt. So they issue more debt. What they do is they push it back further. They pay this off and they push the debt, and they'll offer a new senior note at a later date. That is a Ponzi scheme. By taking new investor money, by paying back previous investors, existing investors, that's the definition of a Ponzi scheme. That's exactly what's happening. Now, some companies are using more debt, and some companies are using a Ponzi scheme by issuing more stock. That's how they do it. It's called Ponzi stock finance. Now, I've shown this chart before, and what we just saw previously is the same thing for the entire industry here. It's the debt wall, the amount of bonds, U.S. energy companies, and these bonds are senior notes. Energy companies below investment grade need to pay back each year, and as you can see, it continues to rise. But what they're doing and what they have been doing, they're not making the money. I've showed you, no one's really making money. So to pay back the debt that's due in 2016 and 17, they issue new debt, and then they push it back here, 2023, 25, 28, 35, wherever. Now, the problem is, as I explained, these shale fields, and let me just go back really quickly. These shale fields are not producing enough energy or enough oil and enough profits to pay back the debt in the future. With these massive decline rates, it's like they're treading water. Now, the only thing that's kind of propping up the shale oil industry recently is the higher oil price. But I don't believe that's going to last long. But this is the problem they're going to face in the next few years, because these shale companies need a higher oil price to kind of tread water. And if the oil price falls below 50 or 60 or $50, then they start to get into serious trouble. Now, I talked about the oil price for several months. I thought we would see a peak in the oil price, and we did. And that was because of these massive commercial short positions. As the price of oil increased, I showed in many videos how the commercial net short position increased. And then it peaked here. The price peaked at $66 in the beginning of 2018 in January, and then it fell. However, let's take a look at a more recent price of the oil price, recent chart. This is where I was showing it this January. Now, the reason why the oil price fell, it fell along with the stock market. The Dow Jones was peaking about right here. See, the West Texas oil price declined with the stock market at the beginning of February 2017. It was 26,600. The Dow Jones fell down to 23,500. And then it moved back up to 24,000. And it's been fluctuating. However, the oil price has continued to move higher. And it's now trading at 71. Now, the reason why is record speculative trading has pushed it higher than I realized. But when the markets suffer a huge correction, so will the oil price. Now, I've said I knew the stock market was going to peak, and it did peak. And it's been trading in a range of between 24,500 and 23,000. And it probably will continue to trade. And it may even go higher. But it looks like a confluence of events, factors that by the fall, I think we're going to see a major rollover starting to take place in the fall. Now, that's not a guarantee, but the longer the market continues to trade in this range, each month that goes by, it'll be even more severe because there are still economic cycles. Everything is highly margined, and we're starting to see the economic indicators, housing sales, things are starting to roll over. So when the markets start to really roll over, then we'll see a huge fall in the oil price. But just like in 2008, the price of oil did shoot up to 147, but it went up much quicker. And the way it's trading now, I don't think we're going to see that kind of price movement, but it could continue to move higher over the summer because the summer is the major driving time of year, but that's not a guarantee. All I can say is when the Dow Jones starts to really fall below 20,000 on its way to 15,000 and below, that's when the oil price will start hitting back towards 40 and 30. And this is what is going to gut the shale oil industry. Now, one of my readers sent me this chart, and it's one of my last charts. It's called the cash gusher. If they're not making cash, they're spending cash. And it came from, says shale companies are still spending more money than they're making despite rising oil prices. According to the Wall Street Journal article, of the top 20 shale oil producers in the U.S., only 5 generated more cash than they spent in the first quarter of 2018. That's 1 out of 4, or that's 1 quarter. And I would imagine the free cash flow they're making isn't a lot. But you see all this red here. If they're spending more money than they're making, then they have to be adding debt or issuing stock to make up the difference. Now, when the oil price does fall back to 60 and then 50 on its way to 30, it's going to pull the legs out from under the shale oil industry because we have to remember, as I mentioned, the Bakken and Eagle Ford, the core areas have already been produced. The Permian is the kind of the last man on the block. However, if oil prices really start to fall this year, it's going to make a bad situation even worse. So, and we have to also understand the amount of the economic activity now, the amount of trucking, the cost to produce shale oil and gas in North Dakota, in Oklahoma, in Texas, and in New Mexico, and even in the northeast area where the Marcellus, there's a lot of economic activity to produce this oil and gas. When that really starts to fall apart, it's going to pull down the U.S. economy. And when the market realizes that there is no plan B, that shale oil has peaked, finally peaked, and I believe we're going to see a major Enron type of event in the U.S. shale oil industry, it is going to pull down the U.S. economy and the U.S. dollar. So I want to conclude by saying it's important to understand the energy, especially the U.S. shale energy industry. The energy return on investment is so low, they're not making enough money producing this. All we're doing is driving trucks and moving sand and moving equipment. It's so expensive. That's not really helping our GDP. So I totally believe that the lousy shale energy economics will pull down the U.S. economy. And it's also the reason why people should consider owning safe assets like precious metals. Now, I want to thank you for watching the newest video. Please consider, if you haven't, subscribing to the SRS Rock Report YouTube channel. Also, would you please consider being a member or supporting the SRS Rock Report at my site, which you can use PayPal, or if you go to Patreon. I have SRS Rock Report Patreon. I do appreciate supporting the website, and thank you once again.